What if I told you that a single country's secret could bring an entire continent to its knees? Today, we're going to unravel the story of the Greek debt crisis. It's a wild tale of financial smoke and mirrors that didn't just bankrupt a nation, but almost took down the whole global economy with it. So let's dive right in. The whole story really boils down to this one huge question. How on earth did one country's cooked books manage to threaten the very existence of the European Union? The answer is a pretty stark lesson in just how connected and fragile our world economy really is. All right, let's rewind the clock to the late 90s. There was this real sense of optimism in Europe. The euro was the shiny new project, this big symbol of a united future. But to get into this exclusive club, you had to prove your economy was absolutely rock solid. And for Greece, that wasn't just a hurdle, it was a massive brick wall. These were the rules of the game, called the Maastricht criteria. Think of them like a super strict financial stress test. Your annual deficit had to be tiny, below 3% of your GDP. And your total government debt, it couldn't be more than 60% of your entire economic output. These rules were not suggestions. They were there to keep the whole euro project stable.
And this right here really shows you the problem. On one side, you've got the strict rules of the Eurozone, and on the other, you've got the reality in Greece. Their debt was nearly double the limit. Tax evasion was basically a national sport, and government spending was just completely out of control. I mean, they weren't just missing the target, they were in a different solar system.
So what do you do when the numbers just don't work? Well, Greece turned to some very clever financial wizards at Goldman Sachs. They cooked up this incredibly complex deal involving something called a currency swap. Basically, it was a piece of high-tech accounting magic that let Greece hide billions of dollars in debt, making it look like a simple currency trade. On paper, it suddenly made them look like they qualified. And believe it or not, the gambit worked. In 2001, Greece officially joined the euro. And that kicked off what looked like a massive economic party, a boom fueled by unbelievably cheap loans. But the whole thing, the entire boom, was built on a foundation of lies. Suddenly, with the credibility of the whole Eurozone behind it, Greece could borrow money at super low interest rates, almost as low as Germany, Europe's economic powerhouse. International money just flooded into the country, the government went on a spending spree, and for the average Greek person, it felt like the good times would never end. And nothing captured this feeling of unlimited cash better than the 2004 Athens Olympics. It was this huge moment of national pride, but the final price tag was a staggering 9 billion euros. That's almost double the original budget. When money is cheap and easy to get, it's really easy to ignore the warning signs. But here's the thing, right? A party like that can't last forever. All those underlying problems, the tax evasion, the bloated government spending, and especially that hidden debt, they were all still there, just festering under the surface. The entire boom was a house of cards, just waiting for a little gust of wind to knock it all down. Well, that gust of wind arrived in 2008. The global financial crisis, the one that started in the US, it swept across the world like a tidal wave. And for Greece, it wasn't just a problem. It was the event that triggered the complete and catastrophic unraveling of a decade of lies. This timeline just shows how fast it all fell apart. First, the 2008 crisis hits, and Greece's two biggest industries, tourism and shipping, just collapse. Then, in late 2009, a new government gets elected and opens up the books, revealing the horrifying truth. The markets freaked out, credit agencies immediately downgraded Greek debt to junk, and by early 2010, Greece was basically an outcast, totally unable to borrow the money it needed to even pay its bills. And this was the bombshell. The new government revealed that for years, the old government had been reporting a budget deficit of around 6%. Not great, but manageable. The reality? It was more than double that, a catastrophic 12.7%. The world finally saw the real numbers, and the only reaction was pure panic. So, Greece was on the verge of default, which could have set off a chain reaction that would destroy the euro. Europe's leaders had to step in. But the cure they came up with, well, it turned out to be so much worse than the disease. The rescue came from this supergroup known as the Troika. That's the European Union, the European Central Bank, and the International Monetary Fund. They offered a massive 110 billion euro bailout, but it came with a poison pill: brutal, crippling austerity. The idea was that Greece had to slash government spending and hike taxes to get its house in order. The problem? You don't do that to an economy that's already in a nosedive. And this slide just perfectly explains the trap they created. Economists call it a death spiral. Let's walk through it. Step 1, you force massive cuts. Step 2, the economy tanks, businesses close, people lose their jobs. Step 3, with a shrinking economy, the government collects way less in taxes. And that leads to step 4, the lenders demand even more cuts to fix the new budget hole, which starts the whole devastating cycle all over again. So you get the picture. The very medicine that was designed to fix Greece's finances was actively killing the patient. It was making the recession deeper and making the debt problem even worse, not better. And the human cost of this was just staggering. Look at this number. By 2013, more than 1 in every 4 Greek people was out of a job. I mean, that's a level of unemployment you'd see in the Great Depression. And if that last number was shocking, this one is just apocalyptic. For young people, the unemployment rate hit almost 60%. More than half of an entire generation had their futures, their careers, their hopes just wiped out. And what do you think happens then? Predictably, Greek society just started to break down. Years of this pain led to massive protests, riots in the streets, and a political system that just shattered, giving rise to extremist parties on both the far left and the far right. The country was on the brink. So after 3 bailouts, years of brutal austerity, and a political showdown that nearly saw Greece kicked out of the euro, the dust finally started to settle. But it settled on a country that was fundamentally broken, having lost an entire decade of progress. The sheer scale of the economic destruction is hard to even wrap your head around. The Greek economy shrank by a quarter. 25% of it just vanished. And after all that pain, its debt to GDP ratio was actually higher than where it started, peaking at over 180%. So what are the big lessons here? First, well, you can't build a modern economy on lies. It was a house of cards from the start. Second, the euro itself had a major design flaw. A one-size-fits-all currency for wildly different economies was just a recipe for trouble. Third, imposing brutal austerity during a deep recession is just economic malpractice. And finally, a lot of people make this argument. The bailouts were less about saving the Greek people and more about saving the big European banks that had been reckless enough to lend them all that money. Greece did officially exit its bailout programs in 2018, but the scars run incredibly deep. The whole crisis stands as this powerful and very painful reminder of how quickly everything can fall apart. And it leaves us with this final, really difficult question. When a country loses 10 years of its life, how do you even begin to build back?